Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Ehrman.
Hello, and welcome back to the podcast. Thank you very much for being here. I appreciate it. All right, today we are going to talk about loans and how to take loans. And I've had this question a lot, but I just got this question today. And he said, you know what? I've listened to all your podcasts and I haven't heard you talk about this. So here we go. A lot of people have a lot of questions about how many loans can I take? Do I have to pay the loan back? Should I take it just as one lump sum? How do I do that? And so it's nice that you have control and you get to say, hey, I want to be able to take loans and do whatever I want with loans, right? But there's also a downside to that because of the fact that you're in control and you've never been in control. And so there's just a lot of questions about how to do it and how to do it correctly. Because remember, if we don't do it right, then that can get us in trouble too. So let's just use an example. Let's say that you've got $100,000 of cash value and you need that money for operating. Well, if you borrow all $100,000, then you maybe just want to pay back the interest only. Maybe you didn't sell grain and you're holding grain for better prices. And so just pay interest only on the loan. No big deal. All is good in the world of the policy and loans. If you borrow $100,000, but you've sold all your grain, you've sold all your cattle, you have the money you can pay back, and you're not going to need a loan again for 3, 4, 5 months, then fantastic. Pay it all back, stop the interest, and then take a loan again in 4 or 5 months. But if you are going to pay it back, if you borrow the money and then you want to pay it back just to turn around and take a loan again in 10 days, there's no point in doing that because it's just a lot of paperwork. The insurance company does not care what you're taking loans for. So if you have multiple loans, and yes, you can take multiple loans. If you have $100,000 of cash value and you need a $60,000 loan and a $40,000 loan, the insurance company doesn't care that you took 2 loans. They only look at it as one. It's one loan to them. You have a pool of money, and whatever you have borrowed, you can borrow the rest, but you don't. They don't care. They literally do not ask you what it's for. And that's the hard part for people, is because they're like, well, what if I use that for a piece of equipment? How do I pay that back? Well, you get to pay that back however you decide. And I will say, if you bought it for a piece of equipment, then why wouldn't you set up a 5-year or 7-year amortization schedule with yourself, just like you would have with the bank? You can go online. You can find all kinds of free amortization schedules online. Set up your amortization schedule, put it in your books that this is a payment we have to make back to our policy every year for the next 5 to 7 years. If you bought cows with it, then it's a 5-year payback, or however long you decide you want to pay that back. If you've done a house remodel, pay it back over 20 years. Who cares? Nobody cares when you are paying that back except you. If you don't pay it back, you don't have it there to borrow again. Now, if you're using it for operating, just move it into the checking account and then just borrow and pay back from checking, and checking becomes your line of credit or whatever account it is that you have. Maybe you want to start a brand new bank account that's just operating. So when we borrow from the policy, it goes into that account and you can easily track that. So the glory is that you get to be in control, but it's so confusing because it's this pool of money and we don't know what the company is going to regulate. I mean, if you had money in savings, the bank doesn't ask you what you're taking it out for. The bank doesn't ask if you're going to pay it back. The bank doesn't care if you take that money out in 5 transactions or if you do it in 1 transaction, right? And it's very similar to that inside the insurance company. They just don't ask questions. You go online, you fill out a little form. If you are a client of ours, we will fill that form out for you. You go online, you fill out the form, submit it. Within 3 to 5 days, you typically have access to your money. Now, I do understand that there are some companies out there that are taking 20 days to process a loan right now. They're just shorthanded. The industry is really becoming, certain mutual companies are really growing faster than they can train people, which is a fantastic problem to have. But it's a problem for those of us that have policies and we're like, hey, we need that money. Because if you're me, you'll ask for your money at the very last moment because I forget. So I just did this a week ago that I was like, oh my gosh, I forgot to transfer money to pay taxes because I borrow the cash value to pay my taxes and then I pay it back. But I was like, oh, I only have like a week and I forgot. And if it takes them a little bit longer to process, and so then I did have to reach out to the company and ask them if they can expedite that. And so if you're with a company that is taking a really long time to process loans, just know that you can call the company or your agent can call the company and get some of those things expedited. Of course, they're only going to do it for good reason, but they can take 90 days. The contracts say that a life insurance company, I believe it's 90 days to process the loan. Now, nobody has ever done that in the past. So, and that's not their goal. They want to be able to process those loans faster. Anyway, you can take as many loans as you want. You can pay them back however you want. I had a client ask me a couple of weeks ago, well, she's never used her policy. And she said, so what is the interest rate? Well, the interest rates are variable amongst policies. They're anywhere between 4% and about 5%, or about 6%, 4% to 6%. And so all they're going to do is keep the interest because interest is always paid in advance. When you are borrowing money from a life insurance company, is not like a bank. Interest is held in advance. And so she said, well, how are they going to want it paid back? Well, you are the person that decides that. That is just something that if you've bought a policy and you're not listening to podcasts or you're not reading the book again, you're not interacting with your agent, you're going to easily forget that you control that because we have to make that switch in our brain that our life insurance policy is ours. We control that, not somebody else controlling that for us. That's why we do it. But we forget about that because we think it's an expense and that money is gone forever and we don't have access to it. So this isn't a super long podcast. It's going to be very, very short because I don't have anything else to say on the matter except you do what you want. You can take multiple loans. You can pay it back when you want. You can make interest only payments. At least make the interest only. But here's the thing. Don't be buying something and make interest only on there, and you could be making a payment. If you buy cattle with it, if you buy equipment with it, why are you paying interest only when you have a depreciating asset? Be honest and make sure you're paying principal plus interest. If you are doing a line of credit where we are constantly borrowing and paying back, like I have people that have feeder calves, I have people that have feedlots, people that have hog operations that are going in and out constantly, chicken houses, whatever that might be. That is something where you might just want to pay interest only because there's just so much money going in and out that it's more of a hassle to manage than if we just paid interest only. All right. If you continue to have questions, if you guys have questions on loans and I've not covered those, let me know because loans and the interest charged on those loans are the most confusing piece of all of this. And I'm absolutely happy to do more podcasts on that. But I don't know what you don't know until you tell me. Okay. Because I forget what I've talked about. I don't know how many podcasts we're in, but I forget. Okay. Let me know if you have questions, if you have ideas for podcasts, whatever. Mary Jo at withoutthebank.com, or you can go to themjhotline.com and you can leave me a voicemail there. You guys have a fantastic rest of your day.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.